Hello, everybody. I hope you can hear me well, and I would like to welcome you to the Bitcoin Treasury Company's webinar of Centaura. Before we start, though, let me start with a few updates of Centaura. Our biggest news or update was the release of a first stablecoin vault on Euler for RLUSD. The vault provides some of the highest stablecoin yields in the Ethereum network, and we hope we will support the liquidity growth in stablecoins in DeFi, especially with these vaults. We have reached over 27 million of deployment in the first few days, and so keep an eye on it. For further vaults, we're gonna put out there in the future. Also, we have a new dashboard coming to our Risk Radar solution. We will be releasing an in-depth dashboard and risk pulse feed for Dolomite in the next few days. By the way, you can put down your questions into the Q&A section. We will try to answer as many as we can at the end of the webinar, and we will also monitor the chat. So let's dive into our presentation. Today, we will look very close into Bitcoin treasury companies. Why do they exist? How do they finance themselves? Why some will fail, and why this could be the new corporate finance, the new future of corporate finance. This is a quick overview of the topics we're trying to touch today, and in some of them we will dive a little deeper into, and others we will just skim it off the top. But again, questions are very welcome at the end of the webinar. So first we need to understand, what is a treasurer's job? A treasurer's job is simple but critical. Keep the lights on, protect the capital, and put idle cash to work in a safe environment. That's pretty much what a treasurer has to do. If you fail at any of these, the company is at risk, or its survival is at risk. That's why treasury matters. It's the backbone of the financial resilience for most of the companies. Now, we know what a treasurer does, but then when we talk about Bitcoin treasury companies, I hear a lot of chatter about different names out there. So are they all the same? Some are pure wrappers engineered entirely around Bitcoin, for example, like Strategy. Others are general corporates like Tesla or Block or Bullish, the exchange that just launched on NASDAQ. They just hold BTC on the side as a diversification of their reserve assets. We also have the private firms, for example, Tether. They own an awful lot of Bitcoin, but it's not very transparent what they do with it, or what the actual plan is, why they hold the Bitcoins. So there are different mechanics of the risks you take if you invest in one of these companies, if you invest because you think it's a Bitcoin treasury company. So the dedicated wrappers, like Strategy, they issue convertibles, they sell preferred stocks, they sell common stocks, they have different equity programs to get capital, and with that capital they buy Bitcoin and put it on their balance sheet. They're totally dependent on open capital markets. They're highly exposed to Bitcoin price volatility, and they're they're at risk of diluting equity holders. So it's a very thin path they have to walk to make sure that they can finance further Bitcoin purchases, but also finance the whole operation of the company, pay dividends, for example, and structure the balance sheet as a whole. The general corporates like Tesla, Block or Bullish, as I mentioned before, they just own Bitcoin out of their cash reserves. They have no special debt or finance structuring behind the purchases of their Bitcoins. The risk is much smaller that these guys um, run into some liquidity issues because of buying more Bitcoins. And if they do, they can still sell some of their Bitcoins to help their liquidity situation. Then we also said we have private companies like Tether that some of them sit on a lot of Bitcoins. Um, there, anyways, it's difficult to invest in these companies. So that's point number one. And the second point is you cannot really see their balance sheets. Most of these companies don't publicly show the numbers. So it's very, very difficult to see behind the curtain. What you do have, that is concentration risk. In some of these companies, the Bitcoin reserves are quite high, and they might be rehypothecated for other structures or other financing parts they do. So it's pretty difficult to have a good grasp on what risk you take if you could invest in these companies. So let's look at it again. We have the wrappers. That's the strategy-like balance sheet engineering sort of companies that focus all their energy and their operational work to get more Bitcoins on the balance sheet by using capital markets to finance that. We have the general opportunistic companies, which I believe is a very big market that hasn't really started yet to waken up. But if a lot of these mid-sized to large companies diversify their cash piles into some digital assets, preferably BTC, this would be quite an unlock of capital that flows in. And then the private companies which we talked about. Now, I'm not a guy saying this is this is this has to work. Bitcoin can only go up. This has to work. This is the way forward. Everybody needs to become a Bitcoin treasury company. Not at all. I think the brutal truth is most will fail because they misengineer their financing. A lot of these companies that came out after strategy were just doing short-dated financing, debt financing for buying BTCs. And they have unsustainable dividends they need to finance, or they constantly dilute their shareholders. I think some of them misunderstood or just playing some PR stunts. They just put some Bitcoins under their balance sheet and think now everybody's buying their stock. I think after the first sort of formal wave, this will fade away, and you will see only the well-managed, well-engineered balance sheets that will survive. So again, some may succeed. The ones that structure their balance sheet well, and I try to put a few points down on this slide, what I mean by well structured. So you have long dated convertibles, low coupons on those convertibles, and cumulative preferred shares outstanding to finance your Bitcoins. What is very important, and this is, I think, overlooked sometimes, that strategy is not a leveraged play on Bitcoin. Strategy has over-collateralized their debt with Bitcoin. So they're holding more than double the amount of Bitcoin worth on their balance sheet versus the debt they have piled up to buy those Bitcoins. So they have a very good cost entry price into their position that makes them resilient for drawdowns and another winter, which I'm pretty sure will come at some point. You also need to have a very clear management alignment of what you're doing. So from the executive management up to the board, they all need to be aligned what you're doing. And this is probably the second biggest point when you analyze BTC treasury companies. You need to know that the management is fully on board with that strategy. And then the third thing is your investors. So people need to know you're not investing into strategy because they're such a good software company and having the best product out there. You're investing into strategy because you believe into BTC becoming a new form of capital, and strategy is one of the few that is trying to play this full force. Now, we're not really going into the product of strategy of their preferred share program, but this is something that I find very interesting. They started to play around and engineer around with preferred shares program. Some of them, they even look like a money market fund or a short-dated bond, which is trying to attract capital pools that are, for the time being, in money market funds in traditional finance. On the traditional finance side, they look for higher yield, risk adjusted, and they find their places into some of these strategies, strategy built. So let's zoom a bit into how strategy is built under the hood. On the next few slides, I'm trying to point out a few things we touched on earlier, but now helping with the graphical view on it, how it actually looks like. So we're looking at the debt maturity ladder. We're looking at the liquidation waterfall. We're looking at the risk web, and we're looking at the stack of the assets they have on the balance sheet. And here it's you can see it very well. The Bitcoin holdings of $71 billion worth is way bigger than the common equity, preferred equity, convertible debt, and the secured debt. That's what I meant with strategy is not leveraged and buying Bitcoin. It's the other way around. Strategy holds more collateral worth what they have on the debt side on their balance sheet. Then the second chart, or the right-hand side, is something I try to engineer. There is the SOFR risk-free, so-called risk-free rate, the US dollar risk-free rate. And Michael Saylor started to build a BTC risk premia curve. BTC doesn't have yields, and you can't issue BTC to create yield like a bond in dollars. because BTC cannot be issued. But you can build products with a yield that is based on BTC as capital or collateral. And that's the curve when you plot it, would look like this. So SOFR plus a BTC risk premium. And then I put the products, the preferred share products of strategy onto the chart as well. And you can see the STRC is right at the risk premium curve. STRK and STRD is quite higher up. So there is still a lot of risk premium on top of the BTC risk premium needed to get investors to put their capital in. And then the STRF, which is the very, very long-dated program strategy runs, is back on the risk premium curve. If you look at the chart, you see it's about 4 to 5% higher. And that's pretty much what you see in the lending markets, over-collateralized lending markets. That's what people ask for if they lend dollars out over-collateralized with BTC. We are at around 9 to 10%. Here you see the maturity ladder, and strategy did this really well. So they were planning for long-dated debt and convertibles and secure bonds, and it goes out to 2030. And this is a really big convertible note in 2 billion size with a 0 coupon. So that was, you can say, right at the right time of issuing such debt to buy BTC. This is a bit of a closer look into the balance sheet regarding their equity stack and the debt they built on top of it. And it shows the liquidation waterfall principle. So if strategy has to get liquidated, so if they would go into Chapter 11, you can see the ranking. And this is important if you want to invest in some of these preferred stock schemes. You need to know where you are so you can risk adjust the yield you would like to get depending on where you are in the waterfall process. I was also talking about the risk web. I was trying to put the different risks you run if you invest into strategy. And it's different risks than when you just invest into an equity stock. Now you invest into a stock that has different risk parameters because it is mainly driven by the BTC risk premium. You can still see that the web is very much on the outside on most of the risk triggers. That is a reflection of why the market is asking for quite a high risk premium still. Debatable if this will change in the future. So to me, it's always interesting. Does this balance sheet engineering model, what's the end goal? What's the idea behind this? And what does it mean for the future of money and corporate finance? I think we have two types, number A and number B. So type A is the real Bitcoin treasury company. It's the one we looked at closer of Michael Saylor, so the strategy and the like. They're basically looking to build up a Bitcoin capital formation under the hood of a common stock or under the hood of being a publicly listed company. The operating model is clear. Balance sheet as a product. So you manufacture returns by capital structure engineering. You put convertible bonds under your balance sheet, preferred stocks, at the money stocks. But you're not really having, or most of them not really having an operating cash flow. I mean, if you have like strategy, that's perfect. That makes it more safe. So you can use some of that operating cash flow to pay dividends and repay some of the debt if you have to. Also important, make sure if you build up that company, you'll be on the over-collateralized side. So don't just blindly leverage your equity capital, but make sure you're over-collateralized. And again, that already makes it clear you cannot build up a Bitcoin treasury company within a few months. You can launch it within a few months, but being over-collateralized needs years. Match the tenor to the volatility, so make sure you're not doing short-dated debt refinancing. And again, the dividend policy. Michael Saylor was very creative when he built those preferred share programs. Some of these dividends he doesn't have to pay out. He can basically say, I'm going to skip the dividends. I'm not obliged to do it. And the biggest issue of BTC treasury companies is you have to have liquidity. Like Michael Saylor always said, I'm not going to sell a single Bitcoin. So you need to find other sources of liquidity to finance your operation, pay salaries, keep on the lights, pay dividends, the ones you have to, and so on and so forth. So there is never an option for a Bitcoin treasury company like Strategy to sell Bitcoin to finance some of the operation. So what does he want to do? He wants to transform BTC into productive digital capital. We're not there yet. BTC is not yet a productive digital capital base. We need to have secure yield rails. It can be some sort of institutional lending. It can be that the collateral, BTC as collateral, can be better utilized. Could also be the basis trade, which a lot of people already do or have started doing over the years. Again, none of the BTC holders would like to take any credit or counterparty risk. So we need to find other ways that BTC can earn interest, because if it doesn't, this trade is a negative carry trade that needs to be financed. On the type B, we have traditional corporates and BTC diversifiers. So normal operating companies, publicly listed companies that stick to their corporate treasury principles, liquidities first, capital preservation, and then yield is the last thing. BTC will or can be in their balance sheet structure, but in my opinion, it will always be in small. And these guys will, when they have to, they will rebalance their balance sheet, meaning they sometimes sell BTC if they need more liquidity or if they deem BTC being too volatile or compliance reasons if something pops up again. And they finance this with the operating cash flow. So the add-on point to this is they have the optional convexity of the BTC upside. So it's a bit like I'm Microsoft. I have a cash pile I'm sitting on. Maybe I invest some of that into AI companies, and I try to have upside on being early on investments like that. BTC can be very similar, as you say. There is still upside in it. I want to have some, and I put it on my balance sheet. Now, I try to look at it as well from a global capital markets angle. At markets level, are we just moving capitals between pockets, or are we just repackaging? I think the wrappers are a reuse of familiar tools. We all know wrappers in other shapes or forms in the financial industry. So for the time being, to me, it looks like that we are wrapping liquidity from the very TradFi side into BTC-linked paper premium or risk premium. So to me, strategy is a kind of in the middle solution that is probably not the end goal, but it's a needed entity or solution that helps us to move capital, massive capital pockets from one system to another. If Saylor is right and fiat markets are gradually shifting towards a Bitcoin being a pristine collateral, then the first step is the collateralization where BTC can rise and shine. Repo markets would be the first that comes to my mind. Then is the plumbing of settlement rails. So we're moving the old T+2 pipes into 24/7 possible settlement rails. Benchmarkization, I mentioned this in one of my interest rate curve charts. I'm pretty sure that the SOFR plus BTC risk premia will shrink, and maybe at some point in the future, the BTC premia curve turns into a BTC discount curve because it's just better collateral than whatever the dollar free, risk-free rate, government bond yield rate has to offer. And phase 4 is we see actual central banks around the globe using Bitcoin as a reserve asset. Now, I don't know how the future will actually look like. I just try to look out for indicators that could signal me that there is a change. So if I see that BTC gets treated as proper prime collateral, this might be one of the first things to look out for. If we see BTC-backed issuance that come out where we see the coupons are being lower and lower towards the SOFR rate, that would be an indication. Accounting and tax regimes, if they get globally more aligned, that helps. Basel, the Basel regulation still needs to catch up. And if we see more index providers launching BTC-linked preferred or convertible baskets, that will make the BTC credit curve more visible. I think those are all indications and signs we should try to use to focus on to see if the market will change. I'm getting to the end of the presentation, but for the ones that stick with me for the 30 minutes now, I have two links. Those are quite easy to use. They help you to find BTC companies. They help you to structure them and look at various key indicators and numbers, how many BTC treasury companies we have, even Ethereum or Solana companies are on there. It's a good toolbox to have to look at it and follow this market. So again, thanks a lot for listening and participating. And we will now move over to the Q&A section and the chat. Let's have a look. So the first question is, or it's more of a statement. We can also classify crypto asset treasury reserve entities by their crypto exposure and by the degree of crypto business integration in results in four classes. Sure. I think if you want to filter that down deeper, that makes total sense. Or if you want to be a bit more granular on it, that does help. And that's a good input. Then there is a question about market risk. So, do you have a sense of how much BTC holdings is with hedge fund treasurers who buy BTC versus futures? Is there a risk to the market if those trades are unwound? You're talking about the basis trades. Yes, basis trades, we have them in the market maybe for at least 7 to 10 years, and they always get built up and wound down, and the market is able to absorb these kind of um, unwinding of position, but sometimes it also adds to the volatility of the asset itself. But I'm not worried that these hedge fund treasuries own large amounts of Bitcoin and trade the basis. The market can handle it. How realistic is expectation of MNAV bigger than 1 over a full BTC cycle? That is difficult to say. Um, I I don't really have a view on this. Last question, or the last one I see on the chat. Um, the presentation will be on our website downloadable, but I have to check with my marketing guy, but I'm pretty sure that is possible. And the question was, what did you mean by strategy risks diluting its holders? Well, if strategy never sells a single BTC, and they are not financing further purchases with debt, they will issue more preferred and common shares. If they do that, they will dilute existing shareholders. But this is this fine line a BTC treasury company has to walk when they want to buy more BTCs. They will dilute existing shareholders. Ah, there is a next question on the chat. It is about so Strategy's balance sheet is designed with approximate 100% over collateralization, so double the size or double BTC holdings is worth double what they have on the liability side. Does it mean that if a price falls 50%, they are close to liquidation? Ah, that's a good point. People are always afraid of that there is a liquidation level. There is no liquidation level for Strategy. There is never, there cannot be a incidence where Strategy gets liquidated by the market. Only Strategy can decide to sell Bitcoin. But if they don't, they don't. What happens is, though, the stock price of Strategy will absolutely tank if people lose the belief that Strategy can keep the flywheel going. When prices go down, MNAV will definitely feel it, and people will sell Strategy shares. But that doesn't mean that they get anywhere to a liquidation level. There is no liquidation level for Strategy. Also a good question. What do you think about treasury companies accumulating ETH, SOL, or other assets? So there is this debate about BTC not yielding anything, but ETH and Solana, they do. So it eases a bit the financing part of, buying more ETH, but then having also the staking reward or potential looping and liquid staking rewards of your treasury. Um, you just have to think about the end goal. Do you believe there is a world in the future where ETH or Solana is a new form of capital? I don't really see that. That's why I tend towards Bitcoin as the only asset that makes sense to have that sort of end goal. But if you say, well, I like this sort of, let's take pockets of capital from TradFi and repackage it or wrap it into a ETH or Solana Bitcoin treasury company and ride the positive wave of digital asset price increases for a medium term strategy. This could be something to look for. Absolutely. Um, There is another question. MicroStrategy premium versus BTC value is decreasing. This makes sense as more institutional investors can get direct BTC exposure? Question mark. Many pensions and foreign entities still can't have direct exposure. So yes, I mean, at the beginning, Strategy was definitely profiting from companies or investors that couldn't buy BTC and there wasn't an ETF available. Buying Strategy was a good proxy to get exposure to Bitcoin. Now we have the ETF, and you have other possibilities to get your hands on BTC, but the jurisdiction topic is still a good one. So Strategy is US based, so it's US jurisdiction. But then why couldn't we have a Bitcoin treasury company in Europe or Switzerland or the UK? Different jurisdiction, different accounting rules, different sort of tax rules, and so on and so forth. So I see value in setting up Bitcoin treasury companies in different countries. And by different countries, you will also please or serve different investors that do not want to buy US equity or Strategy. They would like to buy euro denominated stocks, for example. Last question. I can only speculate about this. What do you think the winners will do to differentiate themselves? I think I have a few points. It's the way the balance sheet gets engineered, like strategy does it. Second part is the management and the board has to be aligned. So this is something that needs to be there from the start. And the third one is to have a vision for the end goal. I don't think just doing this flywheel just without having a vision like Michael Saylor has it will not work. So you need to have a vision. All right. So that's it. We went through all the questions, or most of it at least. Um, Thanks again for participating and being so active on the chat with questions. And I wish you all a good evening or a good afternoon, depending where you are. Thank you and goodbye.